Welcome back to another episode of the Lone Star Capital Podcast with, of course, the founder and principal, two-time author, Rob Beardsley, and, of course, the host, Craig McGrother here, the Director of Business Development. How are you today, my friend?
I'm doing excellent. It's good to be back, although virtually, but back to a regular podcast where we don't have a guest.
Yeah, no, and we've really enjoyed that. It's been nice because super busy for the last couple of months. It's slowed down here because it's Passover right now. But nonetheless, it's fun to get back to the regular schedule programming and to hit topics in more depth as opposed to having conversation with people dropping their expertise here going on. So fun stuff there. With that said, let's get into housekeeping. We've got a deal coming up in Dallas, which I believe is going to be a 506C. If it's not, well, then it's not, but it should be a 506C. We've got some deals around the corner there. We've got our summit event coming up in September, which is the 15th and 16th of September. We're cramming it to a more glorious pre-party, a more extended version of that at the Carnegie Club there. And then massive, dense, but fun, jam-packed day for the full meat and potatoes on the 16th of September. So it's a Sunday afternoon and Monday conference there. We're absolutely thrilled. It's going to be tough to always level up the bar and keep on upping our events to make sure that people keep wanting to come back and, leave with a very good taste in their mouth. But I do believe we've achieved, yet again, more conference alpha and a better moat to having the most incredible jam-packed event possible coming up here. So we're excited about that. So that's a little housekeeping items for you. Rob, did I miss anything on that front as well that you'd like to plug?
No, that's perfect. Definitely as we get closer to the summit in September, get more excited. And looking forward to hosting everyone and having another great event.
Yeah, and I'm going to say this now, but if you're a capital allocator or if you're an LP passive investor wanting to learn more about Lone Star Capital, you want to reach out to me. My email is Craig, C-R-A-I-G, @lscre.com. Once more, Craig at lscre.com if you're looking to learn more about Lone Star Capital. Let's say you have a 1031 exchange going on. You've got a self-directed IRA that needs, to get better returns. If you're looking to learn more about, raising funds for our deals, or if you're looking more on the passive side, looking to learn more about us, once more, email me, call me, whatever, not hard to find. Craig at lscre.com. Whew. Okay, well, let's start things with the first item on the agenda, which is a Q1 recap. So this is a little bit delayed, but nonetheless, Q1 was incredibly jam-packed. I feel like I've met with the entire industry over the last, Q1, from start to now, with all the conferences we've done. I went to 6 events, I want to say, and covered a lot of ground there. Wined and dined and entertained and had a good time the first part of the Q1. But it's overall been very successful. I'd love to hear your take on it as you kind of look retrospectively at it.
Yeah, I'd say overall it's been a great Q1. Like you said, we have done a ton of conferences and networking, and that's just kind of how the year works out, because at the start of the year we've got NMHC, which is a big event for everybody in the multifamily industry. So we attended that in San Diego. Let's forget about the fact that I got the flu and basically missed the whole thing, but hopefully I'll get it right next year.
That's why you have me come.
Yep, for sure. Got to be able to, step up and fill in. Absolutely. So NMHC, I had a great time speaking at RaiseFest. I'll actually grab my bobblehead real quick.
Yeah, it's gangster.
Yeah. So for those only listening on their podcast device, you're missing out on the YouTube, but you can see that Hunter sent me a really cool bobblehead of myself. And he said, thanks for rocking the stage at RaiseFest. So that's pretty cool. I've got my bobblehead is holding a guitar, and it looks like I rocked the stage so hard that my strings are breaking. So I've got some broken strings on my guitar here.
Well, what's not broken there is your bobblehead's hairline, because that hairline is incredible. That bobblehead's hairline looks like it's taking its Propecia and everything there to keep that on tact, huh?
Yeah, that's a very accurate representation of what we got going on here. So yeah, I appreciate that.
Yeah, well, I'm glad they did do some justice there for sure, pertaining to that. So Q1, you spoke. What else happened for you? What else are your takeaways?
So What other event did we attend? Well, we just got back from Best Ever, so that's another must attend, right? So many people in the industry were there. We hosted some fantastic dinners. We haven't even talked about that, so why don't we do a little recap there and go over that? I mean, we recorded the podcast with Rise 48, so I'll let you take it away and kind of recap our Best Ever experience.
Yeah, well, I think Best Ever went down as one of the most productive conferences that we've had. Race Fest similarly, very, very productive, but Best Ever was really, really special. And Best Ever is such a fun mix of just people. So you've got LP investors there, like true LPs, where we actually connected with. So if you're listening to this, hello, it was great to meet you at BEC. But, institutional equity groups, boutique capital raisers, fund managers, capital allocators, and then institutional equity. So it was a marketplace of all these cross sections coming together. So we got to meet with a ton of people that we'd never met before. A lot of our current, partners that we, are doing, programmatic deals with. Some new partners as well. And then my favorite part of this event, and honestly, we hosted 2 great dinners at event. So it was just really fun to entertain like that and to truly, kind of distinguish ourselves and kind of these people as not just another person you're emailing to deal with, but, people who we are genuinely now I can call as friends and people that like we can shoot the breeze with, have a conversation with that's outside of business. And that was just so much fun. It really, I'm getting chills thinking about it because those dinners were truly like pure pleasure. It's like you go to the conference, sometimes you have some monotonous conversations, you get in a conversation that maybe you wish you didn't get yourself into, but that's just part of, business and life in general. Not everything's always linear, but then it was the times that we had dinner and just connecting with people there was super fun. So that was truly the highlight for me was the dinners, the hosting, and just getting to know people on a deeper level and making sure that we want to do business with the people that are there. Because if you're doing these deals, you're kind of married to each other for 5 years, I would say is the projection timetable. So to make sure that you're with good people, and then also just on the good people note, it was just really fun to know that there's just people out there that are, very like-minded to us, that are looking for the same things that we're looking for, that are looking to grow together, learn together, and just share information and knowledge and grow. And I felt like that was all accomplished. So I just felt very warm and fuzzy and tingly after the event, and the dinners were just so fun. I mean, I think that one dinner, I haven't laughed like that in a very long time. So that was always a very much so a pleasure for me.
Yeah, that was really cool, and it is a really awesome experience to see it happen before your eyes, where you see someone going from a business relationship to a true relationship or a friend relationship, right? Where earlier in the day you're sitting down and maybe having like a very business interaction, but then all of a sudden you could see it happen right before your eyes. All of a sudden that joke comes out that you wouldn't say normally, or this person cracks out of their shell, and all it turns out they're actually really funny, right? And so you never knew that about these people, and that's really what life is all about. Life is way too short. There's a million ways to make a buck, so it really at the end of the day becomes way more important how you make your living and who you do it with than actually just racing around trying to get deals done and make as much money as possible. I mean, obviously that's what we're here to do, and we're here to be excellent at what we do, but really the who is what it's all about.
Couldn't agree more. And it's super fun, and things should be taken seriously. When it talking about raising equity and putting your name and your own dollars at risk, it should be taken with life or death seriousness. So I understand that. And there's some people that you're going to do business with that you may not love their personality, but it is a good business relationship. So there were some people that didn't really know that well, and then kind of after the fact, I'm like, wow, like I genuinely really enjoy you. I did not know about this side of your personality, which was so rich and fun and vibrant. And now I'm thinking about, like, wow, like I can't wait to see that person, which before I was like, yeah, whatever. I got a meeting with them, blah, blah, blah. But now it's the other side of the spectrum where I'm sure if we look at each other, we'll just start laughing because we have this memory and, connection together that, transcend just talking about multifamily deals. But I know them as a person and they know me a little bit more as a person. And it's just beautiful when those things cross together and you level up that, relationship. It's just so valuable. So this goes back to what we're seeking for. And when you have nights like that where everything kind of comes together, and you have all the meetings. The why just becomes that much more clear. And as you mentioned, life is too short to not enjoy who you're doing business with. And naturally, if we need a buck, we'll take a buck where we can get it. But if we have optionality, which we kind of have right now, I certainly know people that I want to work with more than others. Not to say that we're discriminatory too much, but it just feels really great to know that. And just with BEC, we had 25 meetings, which is basically a full stack. I think we had no more than an hour of total opening there. And then we hosted about 24 people to dinner for 2 nights, different people every night. So it was just really special to have that come together. And on my end, selfishly, it's nice to know that, that I'm doing my work because, sometimes I'm a little bit of an island. So it's nice for me to brag to you that we had this event and experience and it was worth your time to go to the conference to make sure that you have a good taste in your mouth to go to these events moving forward. So that's a big thing for me to uphold.
For sure. So on the deal front for Q1, we closed on one single asset. We closed on Aspire Apartments. I actually just recorded my Founders Insights video, and I covered Aspire and talked about rate volatility and stuff. And so on Aspire, we were super lucky, and I didn't get to fully flesh this out in my solo video. But on Aspire, like I said, we were able to actually get lucky and close with an interest rate below our pro forma. So when we signed up the deal, meaning we struck a deal with the seller, we underwrote a 6% rate, and that was in our model, and that flowed through to our projections to our investors. Well, 2 weeks before closing, we were able to rate lock the deal at a 5.72% interest rate, which only juices up the numbers further. Also, it turns out we were really conservative with our insurance estimate on the deal, and so that is looking, that came in better and should work out well there as well. And that was also just in kind of Q4, Q1. That was peak hysteria related to Texas insurance and probably insurance nationally. People just were saying, oh, insurance is going through the moon. If you're coastal Houston, you've got to be underwriting $2,500 per door minimum. And so that was peak hysteria. And so if you were actually able to lock a deal in back then, let's just say in January or something, or February, and you underwrote that peak hysteria insurance in your numbers, and then now insurance we're actually seeing in many cases come down and really calm down, right? That goes straight to your bottom line. That goes straight to your cap rate and your income. So that just speaks to buy when people are fearful, and be fearful when people are greedy. So it worked out well for us on Aspire, but on the flip side, we're seeing every day Treasury volatility negatively impact us, negatively impact the market. Fortunately, we haven't had to compromise or have to walk away from a deal or anything like that, but we've made some strategic pivots, and we're always staying ahead of the curve. And which hopefully we'll be able to talk about soon in a coming podcast and really unveil some more Lone Star magic. But I guess the point I also want to make is, number one, Treasury rate volatility can work in your favor, where you sign up a deal and then rates actually are volatile downward, and then you get a better deal than expected, or they could go against you and then the deal could get worse, and that's when things can get messy. But the other thing generally, whether volatility is up or down, volatility is just negative for transaction activity. Buyers and sellers are happy to do business whether there's a Democrat in office, a Republican in office, or if the sky's falling. But as long as people know the rules of engagement, people can get deals done and business can continue. But if the rules of the game are constantly changing or interest rates are constantly changing, that's when people just end up sitting on the sidelines. So we have just generally this year been very selective, as we generally are, and we've been sitting around watching a lot. And I think that's a good thing because that's reflective of our desire to do the best deals for our investors rather than just trying to slam deals together and collect a fee from our investors.
I love that. And, it's the market's going to give you different things at different times. And as Sam Morse, famously said, when Treasuries moved a couple bips, it was like, what's going on? Now we're so used to things just changing. I just pulled up the Pensford letter when you were speaking there, and I come to find out just that, rates, of course, up today, another 8 basis points. It's insane. So
that's a huge
how
move.
do you make anything work? So, but the pro is that we've got, a deal that we're closing. We've got another deal coming up here that we're going to kind of be going live with, I want to say in a week or 2 weeks' time, which is super exciting. But the interesting thing is just how much variability there is right now. It's out of control. It's really nuts to see things move at the clip and pace that they're moving at. This is not natural and this is not normal. And the exciting thing I will say is that we only have a couple deals we're at so far right now. We've closed the one earlier. We've got one that's closing next week, or this week when it comes out, I should say. And then one that'll be closing probably late June, early July, which we're doing, a synthetic bridge on seemingly, which we're not really as interest rate dependent because we're getting a deep in the money rate cap, which we'll explain at a later date. But how grateful are we that we did not win more deals? Because frankly, Treasury is going up, 40 basis points like we saw a couple weeks ago in 1 week, just makes everything not pencil and not work. So kind of the theme of the year is, if you locked at the right time, then you look really good. If you did not, your deal does not look good and you may not be able to close and raise for that deal. So we're still going through this, immense amount of volatility. And then we've got, CPI numbers that are, not agreeing with where we need to be to get rate cuts going. So seemingly this whole rate cut, 7 or 6 cuts or whatever, 4 cuts, that could be a misnomer. That could be just all for nothing. So it's kind of an interesting takeaway that we're not really getting the numbers we need yet to cut rates. So the Fed and, everyone at B is in a little bit of a pickle right now. And, direction and the path does not seem to be very clear there. And I think the one thing that I want to reiterate and stress to everyone is that, do not bank on anything happening, especially at this time. If you're just banking on rates to get cut here, you could be waiting for nothing. So, just realize that may not be coming and, brace for impact if you're, in a sensitive situation pertaining to that specifically.
Well, I think rate cuts are definitely coming. It's just that they're not coming fast enough or not coming as soon as people had previously expected. So it's just a function of when. But the problem is, generally speaking, and I don't want to derail the conversation in this direction, but if you are banking on rate cuts in a certain amount of time and a certain amount of rate cuts, it's usually not going to work because the Fed's going to cut 2 times, 3 times, maybe another 3 times next year. SOFR is not projected, at least, to go to 0. So, and a lot of people's problems are not going to be solved with 3 rate cuts. And when it comes to problematic situations, you need 2 things. You need time and money. And people are steadily every month running out of both. So that's a whole other discussion, and we've kind of talked about that forever, and who knows what's going to happen or when it's going to happen. But yeah, that's the volatility on the Treasury side is really challenging, and that kind of leaves you either to sit around or bake in a huge cushion or take the risk or do floating rate. And that, if you don't mind me, that brings us to a very nice transition to something I said at one of our all hands meetings the other day, which is we're approaching rate parity. And I said that without really fully explaining what that meant. I said it off the cuff, but what I'm saying when I say parity is that treasuries have been running up so much that fixed rates are nearly the same as floating rates today. And not to, go over this a million times for people who understand financing are going to just, this is old hat, but floating rate.
Yeah, feel free to accelerate 2 minutes.
Go 2x speed through this.
Right.
All the geniuses listening. So floating rates are based on SOFR, which is what basically the Fed controls. SOFR today sits at about 5.3%. And then there's generally a lender spread above SOFR, which then derives your all-in interest rate for your floating rate loan. And of course, if the Fed lowers rates, then that will lower SOFR, and then now your interest rate will be lower, but your spread is fixed. So let's just do super simple numbers, and let's assume a spread of 200 basis points. So that means if you have SOFR of 5.3%, a spread of 2%, that means your all-in rate today on a floater is 7.3%. Now, that's a super high number, but especially when you compare it to fixed rates, and especially when you compare it to fixed rates of 2 months ago, 3 months ago, right? Like I just mentioned that we closed Aspire with a 5.72% fixed interest rate. And we closed the Broadstone refi last year, a year ago exactly almost, at 5.12%, right? So 5.12% or 5.72% are both way lower than floating rate today at 7.3%. Now, of course, if you're a believer in the Fed lowering rates, then that 7.3% rate's not going to be there for long, because the Fed lowers, then it goes down to 7, then it goes down to 6.5, then to 6. So if you're modeling out a floating rate scenario, you're going to want to look at what your blended interest rate is projected to be over the next 1 year, 2 year, 3 year, 5 year, if you are contemplating a floating rate loan strategy. But when looking at just head-to-head rates today, fixed rates have run up, right? 10-year Treasury today is 470, we'll call it, just to keep the math simple. 470, let's just say the spreads are identical, so 200 basis point lender spread. That means you're at a 6.7% fixed rate today. So now we're approaching parity, where your fixed rate 6.7, your floater 7.3, and if you believe that the Fed's going to cut 2 times, boom, that's going to put you pretty much in line with the fixed rate, and then they cut another 2-3 times the year after. Now you're below your fixed rate. So basically, where rates are today, you are almost foolish for locking in a fixed rate, because you are almost certainly going to lose as compared to floating today. The hard part is just stomaching the 7.3% pay rate today, which you can kind of financially engineer out of that by buying a deep in the money rate cap and so on. So that's what we're talking about, where just treasuries have run up so much to now where it's like, even though we are generally fixed rate borrowers and we want to do things on fixed, you gotta at some point face the music and realize, today floating, like this very moment, floating might be the way to go.
Yeah, without a doubt. Or, even the latter, which is, creating a synthetic bridge, right? So can you kind of go through, maybe prime the pump here, talk our own book about, the other equation, which is bridge, and creating, deep in the money rate cap, kind of explain that, because it's still something I'm looking to wrap my arms around, is we haven't done a bridge in my tenure here at Lone Star. So I'd be curious to know how that structures, functions, works, and why it's, a very accretive structure.
Sure. So I'll explain a synthetic fixed rate, and then we'll talk about how that interacts, or how that affects a bridge loan or just a regular floating rate loan, right? Because you can do, not everybody fully understands that you can do an agency loan or long-term financing that is also floating, right? Generally speaking, people associate long-term debt with a fixed rate, and they associate short-term debt or a bridge loan with floating rate debt. But you can actually have the opposite. You could actually have a bridge loan that is fixed, and you can actually have a long-term loan that is floating, right? Those are just kind of the general ones that you see. But what you can do on a floater is you can buy an interest rate cap, which is a hedging instrument, and you purchase an interest rate cap, which basically sets a ceiling on your floating rate exposure. So let's say, just to make the numbers super simple, I'm going to use random numbers. Let's say your interest rate is 5 and it's floating. So it can float to 7, it could float down to 4, but it's at 5 right now. You could buy an interest rate cap at 6, which means that you can float, but if the interest rate ever hits 6 and crosses above it, you are now effectively fixed, because you've purchased that cap, you've purchased that hedge that fixes your ceiling of exposure at 6%. So that is what is called an out-of-the-money interest rate cap, because it's not going to pay you today, because interest rates are 5 today, so you're going to continue floating, and then your cap is giving you protection at 6%. Another strategy is to buy an at-the-money interest rate cap. In this case, that would be at 5%. So that means basically your interest rate is 5%, just where they are today, but if it floats up at all, you're fixed. Your hedge kicks in and you're covered. If it floats down to 4%, you're actually going to get the benefit of that. So an interest rate cap is a partial hedge, because it's not a swap where you're actually swapping your floating rate to a fixed rate. You're getting a partial hedge, so you can still get the benefits of floating down, but you get the protection of floating up. And then finally, the third strategy is actually to buy an in-the-money cap, where you actually buy the cap below where rates are today. So if you have a 5% rate today, you can actually go ahead and buy a cap at 4%. So that will, day one, actually start paying you every single month the difference between 5 and 4, which then effectively creates a synthetic fixed rate loan at 4%. because you bought it in the money below where rates are today. And you can manipulate this, right? You can buy it as deep as you'd like. You can buy a 3% in the money cap.
It ain't cheap.
These things aren't cheap, right? You're buying it from a bank. These traders, they know the market. They're pricing in volatility. They're pricing in the forward curve. So this stuff's not cheap. You're basically paying money today to save on interest tomorrow. So it's kind of like prepaying your loan in a way. And obviously due to volatility, risk, time value of money, that can not necessarily be the best move. But if you want to lock it in, and if you want to manufacture stronger cash flow, this can be a really great way to go. And also to limit variability, because we're in this game to do well for our investors and to help our investors sleep well at night. And if you can lock in that in the money cap and take some of that variability off the table, pay a little more for it, it can be worth it. So that's a very popular strategy these days, to manufacture cash flow through a floating rate loan. And that's true for an agency loan or a long-term floating rate loan. But as you mentioned earlier, it's also true for bridge loans. And bridge loans are most commonly floating rate loans. And people who are doing bridge loans today are most commonly actually buying deep in the money rate caps so that they can kind of create a synthetic fixed rate at a low interest rate so they can have cash flow. Because the reality of bridge loans today is they're expensive. And not many deals, almost no deals, truly have good cash flow on a naked bridge loan. Because if you're talking about SOFR at 5.3% and you're talking about a bridge lender spread at 3.5%, right, that puts you at 8.8, if I'm doing the math right. That puts you at 8.8% on your bridge loan. That's expensive money. So that's why people are doing what they're doing.
Yeah, and I just want to kind of do a little debt conversation as we're on the subject here, and just kind of go through maybe some misnomers, maybe some nuances as to when it's appropriate to take out the correct debt instrument, right? So we've talked about this before, but naturally the deals that are really most distressed right now, the deals that are getting cash, infusions, capital calls that are getting, taken back from the bank, right, were deals that were likely bought in 2021 or 2022, probably the second half of 2021, or maybe actually at any point really, because the markets were so hot throughout, the country, in 2022. And they likely had a bridge or a floating rate debt profile coming up without any security with a rate cap, so there's problems there, right? That was when rates were low and cap rates were low. Well, now interest rates are higher, obviously, and cap rates are higher. Therefore, the math, time, money, you're kind of running out of those things, right? So I would love for you to just kind of back through deals where it makes sense to actually now be contrarian. You maybe get outside of our, kind of deal norm profile, which has been fixed rate debt deals, and talk about circumstances where it would make sense to do a synthetic bridge, a bridge loan, maybe a floating rate deal, things that are, now, I guess, contrarian, because we're not snake bit by those issues, right? So be curious to know, in your opinion, when it makes sense to implement what strategy.
Yeah, it's really important to match your business plan and the deal profile that you're buying to the debt that you want to use. So, and it's pretty simple. If you're buying a deal that is a heavier lift, it's a deeper value add, if there's a bigger transition that needs to happen as far as renovations, raising rents, things like that, then a bridge loan can make sense. Another key there is you can't just have a deal that has a lot of work to do on it. It has to have a stronger yield on cost, because if you're doing a value add deal but you're at the end of the day ending up at a 7% yield on cost, then that could be light. And also, I'm just using general numbers. It's obviously different market by market, but you need a premium. That deal needs to be juicier in order to take the risk of the bridge loan and pay the higher cost of the bridge loan. And then another thing too is that not all bridge loans are created equal. You could do a bridge loan at 80% leverage, and you could also do a bridge loan at 70% leverage. And those are two very different risk profiles. So that's something also to consider. I wouldn't just, if I were an investor, and I'm, let's say, rightfully so, skeptical or concerned about bridge debt risk, well, I wouldn't just dismiss any deal outright. if it has a bridge loan on it, because what if it's, like I said, 70% leverage instead of 80? That's a very different risk profile. One that I can live with. The other I probably can't live with unless the deal is actually a super home run where it can actually handle that higher 80% leverage. So yeah, like you mentioned, we're doing a 506C deal in Dallas. So we're acquiring a Dallas deal with a bridge loan. And because there's the opportunity to raise rents by a lot and to do renovations, and there's a lot of deferred maintenance, and we have a very big renovation budget, we almost need the bridge loan to finance our CapEx, because it's a more capital efficient way to go than to finance our CapEx out of equity, because we would end up under levered. You know, you can be too levered, but you can also be under levered, because at the end of the day, our investors are solving for a levered return. We can't go to our investors and say, you know what, we decided to buy this deal all cash. It's a really good deal, but it's all cash, and we're projecting a 10% IRR to you, right? That might be a really good IRR for an unlevered deal. I mean, that's a great risk-adjusted return, but our investors aren't in it for that, generally speaking. We generally have investors who are seeking mid-teens levered returns, and they also want to get the tax benefits associated with leveraged real estate.
Without a doubt. Yeah, so I mean, I guess just to sum it up, it is not a one-size-fits-all solution for investing and for profiles, and you got to be nimble and adapt, and also, you know, understand when it makes sense to use bridge. And you know, a lot of the questions I've been fielding about, you know, some of our deals are, oh, well, this is a bridge deal, you know, usually you guys are fixed rate. And I always say, hey, listen, we're looking to get opportunistic returns where it makes sense in the marketplace. So this deal coming up, you know, we've got about 150 units that are basically original, need to get turned over. You know, they've got a very, very big delta from renovated units to where we're at currently, where the math makes sense. So there's solutions and situations where you're going to get paid for your work. You just got to make sure there's a viable comp set to make that make sense, where you're not resetting the market and have to have everything under the sun occur for you to make it make sense for the deal to work. You know, if there's, you know, a crazy uplift in the market, then every deal will be okay, typically speaking. But, you know, at a base case, you know, very simple solution, we think that this deal makes sense where, you know, the bridge profile will work, and, you know, it gives us flexibility to maybe exit the deal and kind of recycle capital a little bit quicker, as we think we're very close to the market bottom, despite what may or may not happen with the recession coming up and things of that nature. So with that said, would love to hear your take on kind of this fact, which we heard, I think from Jeremy Roll, which was an amazing meeting at the Best Ever conference, and he was spitting just all sorts of knowledge, as he's kind of a, you know, legendary investor, and certainly is very respected in the business. And I think he said something which was, and I noted this to talk about on the show, which was the last time the 5-year Treasury was this high was April of 2007, which we both know, or we all know, listeners, that about a year later is when the GFC occurred. And he mentioned it takes about 23 months from the first rate hike to the first recession happening as well. So we'd love to hear your take as to kind of that there, as we kind of digest to see, you know, where the hockey puck's going, not where we're at currently, and where, you know, we think it may end up, right?
Yeah, I think I feel like we talk economics a lot, and I don't want to bore people to death about just talking about what's happening in the economy and what's coming next and all that pontification. But yeah, Jeremy made the point that the average time from the first rate hike to a recession is 23 months, and that 23 months comes to us in July. So we're not even at the point yet where we're supposed to have the recession yet, if you follow the historical data. And a lot of people, I would argue, maybe kind of sentiment has changed more recently, but I think a lot of people think that we are out of the woods, or that the worst is behind us and that things are going to improve from here. But there's other data to suggest that we actually have a more weakening in the economy that can come our way. So I think it's just important to respect the unknown and to be careful about what's coming next, which is definitely reflected in our underwriting. We're seeing it right now. I mean, we're fortunate that in the pockets where we own, we're still seeing, generally speaking, positive rent growth. And I was just reviewing all of our quarterly reports that are going out to investors today, and you know, on a handful of deals, we're getting $40 renewals, and so that's a really strong positive sign for the markets that we're in. but there's also troubled areas, especially that have a lot of supply. So if we start to see job losses and a softening in the economy, by way of consumer sentiment to be down and consumption to go down, that's really going to absolutely have an impact in our multifamily fundamentals and our markets. So it's just something that to keep in mind, and something to don't just assume that we're going to get 5-10% rent growth over the next year, right? The next year or so might be bumpier, but I think on the back end of it, it's going to be all very positive, and the long-term trends for multifamily housing are all still very good. So yeah, I don't want to say that we're predicting the future or that we can predict the future. It's just, I think it's good to be humble and careful. Like Jeremy Roll, I would say Jeremy is maybe a little bit too careful, right? He's very conservative. He always wants to really wait around until the dust settles. And I think that in investing, it's very difficult to do that. It's very difficult to catch the market on the upswing rather than catch a falling knife. Catching a falling knife is the harder thing to do emotionally. It's more stressful, but generally I think it's a more successful investment strategy. I don't mind if we buy a deal today that we think is a great deal, but then it gets cheaper or the value goes down over the next year. I'm not going to cry over that because I know that in the end it's going to definitely do very well. So I'd rather get in the game rather than try to time the bottom perfectly, because we all know that doesn't work.
And this is the beauty of being in the space that we're in, where there's no stock ticker on our properties, where, yes, if we buy a deal today and the market drops ever so slightly, we don't have to see, an appraisal or whatever mark-to-market price is on that property, because we're implementing a business plan, we're managing it, we're taking care of it there, and we are forcing value there. But it just makes our, acquisition process a little bit more scrutinized if we don't think there's a clear path. But there's money to be made, I think, every day of the year. Anywhere in this country, someone just bought a deal that will make them a lot of money. It's just up to you to find that opportunity, and it's up to us to execute there on our word and our business plan and whatnot. So I just want to hit on that kind of concept there. Another thing that I found interesting was, did we already hit the cap rate high? So we've noticed that cap rate compression from, I guess one of our deals, Cortland, seemed like to be the Cortland and Aspire, actually, say the two first deals we are working on this year, had maybe the watermark level high on cap rate going in. So be curious to know your take on that there, from what you're seeing after collaborating and connecting with Brad pertaining to the subject.
Yeah, well, we have absolutely seen cap rates compress over the last, let's say, 4 months or so. And so that kind of implies that the peak was somewhere around the end of 2023. So yeah, that's definitely happened, and it happened rather quickly. And I think with the recent, which is crazy to say because cap rates should be roughly correlated to interest rates, but not always, right? There's more than just interest rates that impact cap rates. There's a lot more that goes into it. And I think one of the things that's happening is investors are just tired of being on the sidelines, and they want to put money out. And if you're a fund manager investing in an equity fund, and your mandate is to invest at a 15% IRR, well, if you've been sitting on your hands waiting and waiting and waiting to jump back in, and you're waiting for the right deal, but it hasn't come, right? You've got that pent-up equity demand, and even though your fund mandate is to invest at a 15% IRR, you might have to put that money out at a 12 because you just need to get it out. So you're willing to compress your returns, and that actually compresses cap rates in the face of rising interest rates. And I think we're seeing that to an extent, because even as rates have risen, we've seen cap rates are lower, up to 50 basis points less than where they were a handful of months ago. And that makes getting deals done very difficult. Like I said earlier, we have to pick our spots, we have to find the right opportunities, we have to create some magic. And right now, just with where rates are today, things are, generally speaking, very negatively levered. So yeah, I think that we probably did see the peak in cap rates earlier this year, or somewhere at the end of last year, right? December was just a very slow time, and that's when you can see the peak cap rates. So yeah, I mean, that could be a bottom, but I think, and we've talked about this on the show before, right? There's more than one bottom, and also this kind of speaks to the irrelevancy of a quote-unquote bottom, because the reality is you could have higher cap rates or lower cap rates, but you also need to offset that by where interest rates are, right? Interest rates cap rates could stay the same, but if interest rates drop like a rock, all of a sudden that's the time to buy, right? That's an awesome thing. In 2020, when COVID hit, rates dropped like a rock, and that was the time to buy. That was home run time to buy. Cap rates didn't move, but just rate movement alone made it a time to buy. And then it took 6 months or so for cap rates to catch up. Then they fell, they compressed really hard, and then the buying opportunity was gone. So really what we're looking for is good basis buys, properties that we're comfortable holding long term, that we have strong growth prospects for, and where there's a good spread between cap rate and interest rate. And it's also more complicated than that because you might be negatively levered going in, but through your business plan, you can achieve positive leverage.
I love that. Another concept I want to go into is yields can go down, but cap rates may also compress. I think it's just a beautiful mirroring and matching conversation to kind of piggyback off that. So once more, the concept that yield can go down, but cap rates may also compress. So we talked about this before, Rob, but could you please break this down for the minds like mine who may need you to reiterate it a couple times to fully grasp the subject?
So I'm not exactly sure what we were talking about when we referenced this, but I think this kind of speaks to what I was just saying earlier, where cash on cash is obviously a levered metric. Cash on cash isn't solely based on the cap rate. You have to obviously factor in the interest rate. So we could see cap rates compress, but if rates come down as well, then cash on cash could improve. So yeah, I can't remember exactly what we were saying there, but
I believe where it was rents could go down, other income could go down, but cap rates could also go down at the same time as well, if that makes sense. So it was kind of on that subject and premise there where they're not, I guess, mutually exclusive in that regard, where that could kind of go down a bit, but if we want to circle back to that, we can in the future, of course.
Yeah, I think maybe not yields but prices, because there's two things that make up price. It's cap rate and the income of the property. So you might have a peak in cap rates, that you could infer that, oh, that's a great time to buy because this is the bottom. But that deal could actually get cheaper, not by way of further cap rate expansion, but by NOI reduction. And we're actually starting to see that now. And that's kind of the story that plays out later. And to just zoom out and actually speak to that story, you can see this happen in real time because news gets reflected into the stock market instantly. The stock market reacts to data immediately. And that's why you saw the stock market have a bear market, had a 20% drop or whatever it was, like over a year and a half ago, or whenever that was, when rates went up and all that stuff. That got factored into the market immediately. But with real estate, it takes a long time for that to factor in because transactions take a longer time, and there's it's less liquid of a market, so that takes more time. And then also, we all know that it takes roughly 12 to 18 months for interest rate hikes to be felt in the real economy. So while we've known that the Fed has hiked rates at the fastest pace in history, and we've seen it happen, and it's been going on for over a year now, the economy really hasn't been impacted by it yet. I mean, you're seeing some cracks in the economy. You've definitely seen inflation come down a lot. There's a lot of progress that has been done there, but it takes a long time for that to filter into the real economy. And it's the same thing when it comes to real estate. Cap rates can adjust actually on the fly because buyers can look at a deal and go, well, I want to pay a 5.25 cap. And then tomorrow they could wake up and say, you know what? This deal is worth a 5.5 cap to me now, which basically is effectively demanding a lower price for the deal. But what takes a lot longer than a buyer just changing their cap rate that they're willing to buy at is the income of the property. Because if you wait long enough, you can wait and see occupancy go down, collections go down, rents go down, concessions go up. And in a worsening economic environment, those things play out and those decrease the NOI of the property, which result in a lower value of the property without the cap rate moving at all. So we're now starting to see that. We're seeing deals that we passed on, let's say 3 months ago, 6 months ago, or a year ago, and then they didn't successfully trade, and now the seller's back out at the market, and we're looking at their financials now, and their financials are worse than where they were a year ago. Occupancy is lower, concessions are up, right? There's just problems there, and the deal's worth less. and therein lies an opportunity.
I love that. Very good, and I appreciate the breakdown there. Moving on to a more fun side, we've gotten to the meat potatoes here. Let's get to some good stuff, which was the New York City food tour review. So I have a new favorite restaurant now, and it is, without a doubt, it's actually offensive what pasta tastes like after eating here, and that is Teresi, which to me is the best restaurant I've ever been to in my life. It's actually better than La Giostra in Florence. In retrospect, I've eaten there both places twice. I do have a preference for Teresi in Manhattan, of course. Double yes. That's what we know. It's double the nod there. So with that said, I can't get over it. If you want to elaborate a little bit more on that front as well, which is just truly the best.
Yeah, Teresi has been. I'm really glad that you said that, because I've been hyping up Teresi. So when you came to New York and we were able to take out some investors and go on some investor dinners and also just for fun go to Teresi, it was a really fantastic experience, and it is my favorite restaurant in the city right now. And it, in less than a year, got a Michelin star. So it's the real deal. And yeah, I think it's just great.
Carbone, honestly, is very mid. Which, for those who don't know what that word means, for that jargon, mid is average, just meh,
Middle.
kind of okay, middle of the pack, and quite literally. And Carbone, to me, honestly, is hardly edible compared to Teresi, which is a really crazy statement to be made. But I have no desire really to go back to Carbone anymore in retrospect to Teresi. And that's just how spoiled I am now. This is what happens. You hang out with the big G's, you get into the big restaurants, and you really can't eat at these other places anymore. And my gosh, Teresi just blows the competition out of the water. It's out of control.
So the reason why, just for everybody, the reason why you're bringing up Carbone is because it's the same company, major food group is.
But it's also the new hype restaurant. Sorry to cut you off. Like, it's very, like, if you think pasta, it's apples to apples there, right? Like, you can't compare, Grand Banks to Teresi or to Carbone. It's not like for like.
Same company. They're both hype restaurants. They are Italian. It's just Carbone is trying. It's a new restaurant trying to be classic Italian, and Teresi is a new restaurant trying to be new modern Italian, and they just really nail it. And it's also much more edible. Like, you could go to Teresi every single week, and I
agree.
Not get over it at all. But Carbone, like you said, Carbone's like, all right, we're gonna sit down, we're gonna eat Carbone. It's gonna be heavy. We're gonna have the meatball. We're gonna have the spicy rigatoni, the lobster. It's like, it's a big thing.
It seems like every item on Teresi I could order and be very happy with it. Okay, it feels like that's there, but Carbone, there's certainly some misses on that menu. And
there's only one good pasta.
Well, I also feel like you go to Carbone and it's like you're going to Italian food, but you're not really necessarily eating Italian food per se. You're getting lobster, you're getting the Dover, you're getting XYZ, right? The dessert there is a little bit better, in my opinion, than Teresi, but I think that's the only little delta there that they've got. But I just feel like they're really not comparable. And then on another note, you gave me the wild and incredible pleasure of trying Sushi Nakazawa. Is that how you say it? I always kind of butcher it. So
Nakazawa.
Yeah, that was definitively the best sushi I have ever had in my life. And I had Uchi in Scottsdale, and I didn't realize omakase. I just assumed, because that was my first omakase experience there with you in Manhattan. And this is just me being silly, but I just assumed all omakase was, it's sushi. And then they brought me out omakase at Uchi, and it was like a different kind of experience. It wasn't like only sushi. So, shame on me for not knowing, but if you don't know, now you know. But now I know. So I, with that said, now am wised up. But Uchi in Scottsdale was more expensive than Sushi Nakazawa, which is offensive to think about, because the quality was not even in the same ballpark. So between those two restaurants, I could eat at Teresi, Nakazawa, and then probably like a burger place or a Mexican place, like those four things, and never have to eat anywhere ever again for the rest of my life.
Yeah, all fair takes. Nakazawa's really, really solid, and it's good value as well. Even though, it is very expensive, but when you're talking about New York City omakase, and omakase just means chef's choice, so it doesn't necessarily mean sushi. It just, in Japanese, it's chef's choice. They just bring you out whatever they want, usually the freshest fish and whatnot, but it generally follows some sort of tradition and order. But anyhow, yeah, omakase in New York you can go from 100 per person, 200, 400, 500 to probably the most expensive one being masa, which could be like $900 a person. So not something I've ever done, because yeah, I think that Nakazawa is a great sweet spot. Nakazawa, you can be out the door for about $225 per person, and it is really, really solid.
And yes, that is not cheap, but for the taste that you're getting in the experience, it is definitively the best sushi experience I have ever had. And I really look forward to running that back at some point. So those were kind of the reviews there, the two places that were top of mind. I've yet to try Fort Charles, so I don't know if they don't like you there, if your money's no good there, because they seemingly don't want to let you allowed back there, but that's another story for another day. That was, those two places were truly the highlight of my culinary experience when I was back there in New York for several weeks. So that was absolutely delicious. Now, are you wearing your new German watch perhaps today, or did you throw a hezzy? Yeah, you want to take it off so people get a better feeling and the camera can focus a bit more.
Of course. Yeah. I know what I'm doing here. But also, I have to have you put a little bit of respect on Carbone's name, because I think Carbone's a 9 and I think Teresi's a 10. It's not a world of difference. It's 9 versus 10.
Yeah, but good is the enemy of great.
Yeah. Speaking of great. So it's hard to see in the camera, but what we're talking about today is my new Longa and Son time zone. This is a very special watch, and this is my first Longa and Son. Kent, actually, I don't know if he wants me to say this, but Kent has a Longa. Kent's very private.
He's not going to listen to this anyway, so it doesn't matter.
Very private man. But yes, this is my first Longa, so you can officially say that I'm starting to develop a little bit of taste, a little bit of class,
Yeah, you're not new money anymore.
I'm not buying a gold Rolex. This is a Longa. And so Longa uniquely is a German watchmaker. When all the high horology is happening in Switzerland, we've got Patek Philippe, Vacheron, Audemars Piguet, and Rolex, all being in Switzerland. But this is there we go. This is the
there it is.
There it is. The Longa and Son. So the reason why this
is so let's just describe this real quick. So there's multiple for this is terrible radio, but you've got, it looks like Sydney, you've got Georgia, London, not Georgia like the Bulldogs, but Georgia like the country. You got Moscow, you got Kiev, you've got all these different spots. You know exactly what time it is, where it is. Dubai, which is super cool. So it's a world time, correct? And you've got the date on there. So very sophisticated piece, naturally. It kind of looks like a Calatrava of sorts from a Patek with, on the exterior perimeter. So, yeah, not too thick of a profile.
No.
Is that 40 millimeter, 39 millimeter? What are we working with there?
Yeah, so we've got a 41.9 millimeter diameter.
How does it wear? That looks like it wears small because it's 41, but there's no because this is a 40 as well, but there's some bulk on the exterior of my back girl here, right? That looks to be like 40 and really not extra meat on the bone there outside of the face itself.
So 41.9, so call it 42, right? So same size as my Pilot, basically. But I would say this wears slightly smaller than the Pilot. But the thing when you talk about watches on leather like this is you can see that the strap can go straight down. So not that I have a small wrist and need that, but you don't have an integrated bracelet where the immediate lugs kind of jut out further than the lugs, right? And so these are the lugs of the watch for everybody who doesn't care about watches. And so the lugs also determine the size of the watch. So when we talk about diameter, we talk about from here to here. But of course, right, you actually have this spacing as well from lug to lug tip to lug tip, as they call it. So yeah, it wears really nicely. It's actually funny because I've come such a long way. I used to really love small watches, and I still do. I just think small watches are elegant. But this is, come on, this is a Longa, right? So we've got to make some compromises. But this is also a manual watch, so that means that you have to wind it. It's not an automatic where
so Eli Melech wouldn't like to wear it.
Yeah, Eli Melech would not approve, but I'm convincing him to get into it. So,
well, that's way too old money for his tastes. He likes the flashy big APs, things of that nature. But maybe his taste will change over time, I suppose.
They will. And yeah, so couple last things. So we've got white gold. This is my first white gold piece, and white gold is super
Deviating
cool.
from the rose.
Deviating from the rose. My uncle said I don't need rose, and there's a whole backstory to this watch, and there's a lot. I don't want to tell the whole story just because I feel like we've already taken up too much airtime with this piece, but this is a very, very special watch. I'm very, very lucky to have it. There's actually only 100. This is a limited edition piece. It's the Buenos Aires, I think reference 116.026.
It's actually ironic that they have a limited number of those watches because Argentina has rampant inflation. So very contradictory in many respects there. I digress.
Yeah, very funny. So that is actually funny because the Buenos Aires, not that this is a reach or a surprise, but obviously since it's the Buenos Aires limited edition, one of the cities that goes around the track to tell the time in 24 cities. Sorry, it says Buenos Aires instead of Rio de Janeiro.
You actually had it there for a second. Yeah, but
yeah, let's see if we can get the Buenos Aires. So point is, it's a limited edition piece that came out in 2010, and it ran for 2010 to 2012, and only 100 pieces made, and it's super, super hard to find because Longas are not really traded. Longas are really a collector's watch. People buy them. They keep them in their collection. They don't sell them. I would never, ever sell this. If I, for whatever reason, did not want this piece anymore, it would go right back to my uncle. And my uncle was very reluctant to sell me this watch. He basically sold me this watch on the condition that he could still wear it from time to time when he needed it. So
in a pinch.
In a pinch when he needs a Longa. So I barely consider this mine. But super rare, super lucky to have this. And like I said, first white gold piece. You get the luxury of gold without the flash of gold. And so I think that's really cool in evolution. And then finally, last thing I'll show you is how cool the big date window is there. And also I'll actuate the date here because we're actually recording this on April 30. And we're going to go to 31, but then tomorrow is the 1st, right? So if I click it, come on, tomorrow will be the 1st.
Very good.
So
very good.
This is a very satisfying click, by the way. So
very good.
This is a complicated thing to do, right? This is not a simple date wheel. No disrespect to you, but on your Rolex, right? Because you have the two windows where bang, it's got the 1 and the 0 now. So a whole lot of fun here. And thought it would be fun to share.
Yeah, thank you for the show and tell. That said, be curious to know, what is if one were to procure a Long and Son, is that how you say it? Long and Son?
Longa. You could just say Longa.
Yeah. Okay, Longa. If you wanted to buy a Longa, what's the retail process? Is there retail brick and mortar stores? Is it, ADs? How does one get one? Is there even anything retail if you wanted to walk into a store? What's that process like, out of curiosity?
Yeah, actually, Longas, the funny thing is about Longa is it's kind of like an if you know type watchmaker, and there's not as much hype on them. So you can actually walk in to a store and buy a lot of quality pieces from them directly. And actually, a lot of their pieces trade below their retail value in the secondary market. So Longa, I'd say, is definitely a brand that you have to be careful with, because not all the pieces are going to go up in value and do super well. So you need to really know what you're doing. And at the end of the day, obviously, buy for yourself and buy for your passion. But as far as maintaining value or investment value, I don't want to say it's hit or miss, but it's less proven. Longa is a long historied company, but it went out of business and then it was revived in 1994. So it's on the level of Patek Philippe in watchmaking, but it's not on the same level as far as
clout,
history, clout, and kind of market reverence. So that's something to be worried about. But when you talk about a limited edition piece like this, this is better than gold.
So this is like basically the antonym of Richard Mille, because it's very understated in many respects. It's not a hype piece, and it's been around for a very long time.
Yes, although. Yeah, I mean, generally speaking, yes. Obviously, Richard Mille is it's a newer company, super hyped up, and the long-term investment value of Richard Mills is completely unproven. So not that I buy my pieces solely for their investment value, but I would just be very careful about RM. And generally it doesn't really suit my taste.
Yeah, and the final thought here as well. I actually do love RMs. They've grown on me quite a bit. But final thought I have here is the VC Vacheron experience that our friend had. He said he went in there and really enjoyed the fact that you can actually go in there. And this is part of the Holy Trinity, as you said. So I'd love for you to explain what the Holy Trinity means, the significance of it. But it's, one of the big three watches for Switzerland. And he said the experience was so enjoyable. He actually got treated like a human and not laughed at for wanting to buy, a piece where we all know they may or may not have the Rolexes in the back. And they're just kind of wanting to willy-nilly kind of hold it over the head for some leverage play to insert their dominance there. But would love for you to explain, what the big three is and, just kind of, what your take is on our friend's experience there with procuring a retail piece there that was, certainly not a base piece by any means from the brand.
Yeah, so it's funny because when people think of a nice watch, 10 times out of 10 people think Rolex. And Rolex has to be very
entry level.
Yeah, Rolex is an entry level watch. And Rolex has to be very proud of the fact that their marketing is so good that's
the best
thing that people think of. It's the thing people think of when they think about a nice watch, right? A nice Swiss watch. But the reality is Rolex isn't in the Holy Trinity. The Holy Trinity of watchmaking is Vacheron Constantin, Audemars Piguet, and Patek Philippe. So that's considered kind of that's just the Holy Trinity. It just is what it is. Those are the three watch brands that have the most history, the most clout for watchmaking, etc. And yes, there are other very, very strong brands out there. Longa being, right up there. I would actually kind of put Longa. I would kick out Vacheron and I would put Longa in there. And frankly,
Swiss,
AP,
though.
Yeah,
the AP seems a little. I don't know how AP snuck itself in there because AP doesn't have the longest history, does it?
No. AP has a very long history. It's
I'm
just
mistaken.
That unfortunately for AP, and they're trying to change this, but they've got one hit. They've got the Royal Oak, right? They've got one watch, and they are just milking it. They're just making all these different versions. And to their credit, Audemars Piguet is capturing the zeitgeist better than any other watchmaker because they're doing partnerships.
The Royal Oak is
John
out
Mayer,
of control.
Travis Scott, right? So they're really incorporating. Audemars Piguet is being very innovative. They're capturing the zeitgeist. They're capturing modern culture, right? The watch they made with Travis Scott, that's a very unique thing. Obviously I would never invest in a piece like that because it's just, Travis Scott's here today, gone tomorrow. That's a very big risk you're taking on him. Kind of
so are some of his fans.
And speaking of like taking a risk on one person, if you talk about a boutique watchmaker like FP Journe, you're placing a ton of risk, right? If you're going to buy a $100,000 watch from FP Journe, you're risking on this man, this individual, FP Journe. And turns out there's some allegations against him for, I don't know, sexual misconduct or something like that, or just, the R word or something like that. And imagine if he sullies his reputation, the value of his watches they could possibly tank. So that's a little bit of a rabbit hole. But anyway, AP is at this point kind of a one-trick pony. They've got the Royal Oak. Don't let them at AP House or the dealer hear that because, I don't want to be on their bad side. But, that's the thing. I think, Patek and Longa, I think, are kind of the best brands. And I think Rolex is incredible in its own right.
Yeah, Rolex makes beautiful pieces. It's still my favorite watch brand. I think Rolex and Patek are my favorite. I would say AP is certainly a distant third in that regard. But, the Royal Oak has truly grown on me. But at any rate, thank you so much for tuning in to this episode of the Lone Star Capital podcast. If you want to get a hold of me, you want to learn more about Lone Star Capital, if you got a 1031 exchange coming up, if you're a capital allocator or an LP investor looking to find the best deal in the marketplace, please reach out to me at Craig, Craig, at lscre.com, Craig at lscre.com. For all listeners, thank you so much for tuning in. Peace.